Hello and welcome to PDTV. Tranche 5 of the sovereign gold bond scheme has opened for subscription on Monday for a period of 5 days. The second last tranche for the current financial year has been priced at Rs 4,790 per gram. If you prefer to go online, you can get a discount of Rs 50 on this price. What is SGB? How does it compare with physical gold, gold ETFs, and gold mutual funds as an investment option? We have with us Ms. Shalini Warrior, Executive Director of Federal Bank, to discuss SGBs in detail. We also checked with her if it is okay to make premature withdrawal from SGB after completion of 5 years of investment in case of need. Let's hear what she said.
SGB stands for sovereign gold bonds. So let me explain a little bit about it. I think traditionally Indians have been quite fond about gold as an investment class. Indians tend to buy gold, keep it with them, may not necessarily sell them when required, but probably could pledge them and take a gold loan, etc. But having said that, I think when you take physical gold, there are a lot of risks associated with it, right? You have to store it in a physical form. You have to make sure it's safe and secure. Purity has to be checked. And when you go back to kind of sell it, etc., you may not get the full price. The sovereign gold bonds, therefore, is a very good alternative to how you can get the benefits of gold without some of the constraints of a gold or physical gold. It is literally the government of India has introduced the sovereign gold bonds, and it was introduced about 5-6 years back, November 2015. And it is, like I said, an alternative to physical gold. These are government securities, and their value is actually determined in grams of gold. So you can start with as low as 1 gram, and then there are thresholds and limits, like you can go up to 40 grams, etc. And depending on the constitution, it can be slightly different, etc. The fact is that you can retain it through till maturity, and the maturity is 8 years. What happens is if you retain it till maturity till 8 years, you will get 2.5% interest every year, plus the appreciation from a gold perspective. So if gold was 100 now, and after 8 years, it's, let's say, 110, as an example, that incremental 10 will also come to you, and along with interest of 2.5%. So we consider it as a very safe means to kind of get the benefits of gold value appreciation plus interest of 2.5%, with the principal being protected because it's a government of India security, and therefore it's a very good package for investors. And that's really what sovereign gold bond is about. As the name says, it's sovereign, which is government controlled, it's gold, and it's a bond. So very simple. Gold as an asset class tends to outperform normally, other asset classes, particularly in the environment we are in right now, where there is some amount of uncertainty, there is some concerns from an economic standpoint, etc. There are some geopolitical uncertainty. In that environment, people traditionally rely on gold, and therefore this asset class kind of outperforms itself. So, like I said, there is one aspect of it which is the principal is literally guaranteed. There is also an interest of 2.5%, and then the appreciation in the value of the gold. So I think that all the three combined together give an attractive return for those who are looking for a long-term investment. As I said, it's 8 years to maturity. You can withdraw it before that, probably at the after 5, you can start the withdrawal process. And even prior to that, it is traded, not extensively traded, but yes, there is some trading that happens. And if it is in dematerialized form, you can trade it. So we encourage customers to look at this as an alternative to physical gold. The other advantage of SGB is you can buy it in small tranches. So we have some customers who every month when a tranche is announced by Reserve Bank of India will buy a little and keep it in. You can start at 1 gram, and 1 gram is around 4,800 rupees, etc. So you can buy it at 1 gram, 5 grams, 10 grams, whatever you can afford every month. We encourage people to do that every month. That helps you build up a portfolio for anything that you want, which is a long-term in nature. So at this point of time, individuals, trusts, Hindu undivided families, charitable institutions, universities, they can all invest in SGB. A person can also invest on behalf of a minor. So a parent can invest on behalf of a minor. So anybody looking at gold as an option should definitely look at SGBs. It is a low risk investment, and it is perfect, in my view, for investors who have low risk appetite and a long term view. People who we do not think should invest in gold, to your specific question, is anybody who's looking for short term gains. We've done some work on this to kind of work with customers to show them the differences between them, and we have a good kind of tool that we use with it. First, if you look at it on physical gold, is one option that you could have instead of a sovereign gold bond. Why don't I buy physical gold, whether it's in the form of jewelry or in the form of bullion or etc. First, I think there is no guarantee. You can go and buy it from a jeweler, but you can never be sure about the purity of it. You need to do a lot of kind of checking, and our investors are not jewelers, right? I mean, so they wouldn't know the thing. So against physical gold, I think the difference really is purity, the guarantee of the purity of it. There are incremental costs involved when you look at it, like making costs, storage costs, retention costs, etc. And when you go back to sell it, invariably you will not get what you had bought. That's true of physical gold. So in that sense, I think physical gold doesn't compare well. Then you look at gold funds and gold ETFs, and I'll put both of them kind of in the same category. Both of them are governed by SEBI, Stock Exchanges Board of India, unlike sovereign gold bond, which is with RBI, sovereign guarantee from the RBI. Both gold funds and gold ETFs have some kind of costs associated with them. You've got to pay fund fees, you've got to pay transaction charges. When you go to redeem it, when you decide you want to convert it back into cash because you need the cash or anything, you sometimes don't get the full gold price. You will have some deductions happening on account of maintenance fees, etc. So those clearly don't happen in the case of sovereign gold bonds. So sovereign gold bonds score over in that respect. The other is, post 3 years, post 8 years, if you hold sovereign gold bonds to 8 years, there are no capital gains taxes on maturity as long as you hold it. But otherwise, I think they compare with things. There is nothing materially different between gold funds and gold ETFs because all three of them get 20% with indexation after 3 years. But if you hold till maturity, there are no capital gains. And so you can, from a liquidity standpoint, physical gold funds and gold ETFs can be traded. Sovereign gold funds are traded, but the liquidity may not be as high. So if you take everything into account, I think sovereign gold bonds are very well suited for anybody who's looking at gold as an asset class. It comes with a lot of related benefits, as I explained here. So our recommendation to customers when we work with them is, unless you have a really urgent requirement of funds and you don't have anything else, then we would recommend you hold on to it till maturity, because you will get the full benefits at the time of maturity. Having said that, we recognize that there may be instances of it, and one of the things, some banks have started offering it, and Federal will in due course. You can actually take a loan against your sovereign gold bond. So some banks have already started offering that. That could be an alternative if it is a short-term need for cash, for example. You can take a loan against your sovereign gold bonds. Having said that, the fund itself, the gold bond itself, can be done after 5 years. It can be traded. All of that is possible, but we don't encourage that, which is why we tell customers you should look at it with a slightly longer term view and take this from a longer term perspective.